Welcome to your personalized deep dive. You sent over a stack of materials about this Dhandho investing idea.
Yeah.
Low risk, high reward sounds a little too good to be true, don't you think? What's your take on this, expert speaker? Does Dhandho actually hold up?
Well, that's what makes it so fascinating.
Okay.
The examples they use, they're anything but your typical low-risk ventures.
Yeah.
We're talking about like motel empires, Richard Branson, even steel magnate.
Yeah.
There's this tension there. Makes it really interesting.
Okay. I like tension.
Yeah.
So imagine we've got this stack of books on this Dhandho concept for our listeners out there, plus a few articles on these unconventional businesses, and we're
Yeah.
trying to figure out, what is this approach? Can you actually use it?
The core idea is this. Dhandho, it's a Gujarati word,
Okay.
means endeavors that create wealth.
Okay.
But there's a specific focus on low risk.
Interesting.
You kind of have to flip the script on the usual high risk, high reward idea. You know what I mean?
Yeah.
Dhandho is saying you can minimize risk
Okay.
and still see massive payoffs.
All right. I'm intrigued, but I need a concrete example.
Sure.
What's one of those unconventional businesses that embodies Dhandho?
A perfect example, the Patel community
Okay.
and their dominance in the U.S. motel industry.
Interesting.
Think about it.
Mm-hmm.
They came here, many as refugees with very little capital,
Right.
and they now own like over half the motels in the country.
That's crazy.
Yeah, we're talking over $40 billion in assets.
Wow. That is a staggering number. How did they do it? Is there like a secret Patel motel buying formula out there?
It's not so much a formula, it's a mindset.
Okay.
They applied this Dhandho framework
Hmm.
to an industry that honestly a lot of people might just overlook.
Okay.
Let's break down like a hypothetical first motel purchase to see how it works.
Right.
Let's say Papa Patel finds this like 20-room motel.
Okay.
It's kind of distressed, the price is low, the seller's motivated.
Sounds like your typical fixer-upper. Where's the low risk? You still got to put up some money, right?
Yeah, absolutely. Yeah.
Yeah.
But Papa Patel's only putting down a small amount, maybe a few $1,000s.
Okay.
He gets his family to help run it, maybe even live there.
Makes sense.
Worst case, he loses that initial investment.
Okay, but what about, like, debt?
Ah.
The bank's got to be involved somehow.
Yeah, you're going to have debt.
What if things go bad?
Even then, the bank, they're often reluctant to foreclose on a motel.
Really?
They don't want to be in the business of running a motel.
Yeah, I guess that makes sense.
They're more likely to work with Papa Patel,
Okay.
and he's got the incentive to make it work.
Right, his family's livelihood.
Exactly.
Okay, so the downside is limited,
Hmm.
but what about the upside?
That's the key.
Is running, like, a small motel really that lucrative?
That's the key to Dhandho,
Okay.
the potential upside.
Yeah.
It's huge EE compared to the risk you're taking on.
Oh, okay.
If that motel starts generating cash flow, even a modest amount,
Yeah,
Papa Patel's looking at a huge return on that initial investment.
I see.
And that's how you go from one motel to an empire.
So it's that heads I win,
Yeah.
tails I don't lose much.
Exactly.
Gotcha.
Yeah.
But it's not just about the numbers, is it? I mean,
it's not just the numbers.
there's something about the Patels themselves, right?
You're right.
Their work ethic, their culture,
You're absolutely right.
it plays into it, yeah.
There's a cultural element at play.
Okay.
The first successful Patel motel owners, they became role models.
I see.
It showed other Patels what was possible.
Oh, okay.
Created a snowball effect.
Interesting.
It was proof that this Dhandho approach could actually work.
That's a really great illustration of how Dhandho can work.
Yeah.
In a specific industry,
Mm-hmm.
but can you apply it to other types of businesses?
Absolutely.
Because motels,
Yeah. Yeah.
not everybody's cut out for that.
Right. It's not for everyone.
Yeah.
Manilal Chaudhari is another great example.
Okay.
His family, they were dedicated to saving, right?
Okay.
They had this really methodical, almost Dhandho-like approach
Okay.
to business acquisition,
Interesting.
even though they weren't in the motel business at all.
So he's not a Patel, but he's got that same Dhandho DNA.
That's right.
Okay.
He started small, working at a gas station, learning the business.
Right.
He and his family, they diligently saved their money. They pooled it all together.
Mm-hmm.
They waited patiently for the right opportunity.
Okay, don't tell me he bought a motel.
It was a motel.
No way.
But it wasn't just any motel.
Okay.
It was a Best Western.
Oh, wow.
And they acquired it using a clever partnership structure to minimize their own risk.
So they brought in some outside investors,
Mm-hmm.
but wouldn't that mean giving up some control over, his family's hard-earned savings?
So he was very cautious,
Okay.
but this deal was structured differently.
How so?
He was the one running the motel day to day.
Okay.
So they were essentially giving him capital to manage,
I see.
with his proven track record and his work ethic.
Interesting. So it wasn't just about the money. It was about maintaining that control and leveraging his skills.
Yeah.
I like that.
Yeah.
That's a key insight.
Yeah.
But what about something even more out there, like Richard Branson and Virgin Group? Can you apply Dhandho to something that big, that risky?
That's where it gets really fascinating.
Okay.
Branson, he might not use the word Dhandho,
Right.
but he embodies its principles,
Okay.
especially how he minimizes upfront capital investment.
Wait.
Yeah.
Branson is known for these huge GE splashy ventures,
Yeah.
airlines, space travel.
Yeah.
How is that minimizing risk?
He's a master at finding creative solutions.
Okay.
Let's take Virgin Atlantic.
Okay.
He didn't start by buying a fleet of planes.
Okay.
He leased one 747,
Wow.
focused on a niche market.
Oh.
All business class flights.
Oh, I see.
Right.
So he found a gap.
Exactly.
Tested it without, betting the whole farm. If it failed.
He had to risk everything.
Right, exactly.
And if it worked.
He could scale up.
Right.
Which, of course,
It did.
it did.
Yeah.
Virgin Atlantic's still going strong.
Go fly an eye.
And Virgin Mobile. Same principle, right?
Same thing.
They don't own cell towers.
No.
They partner with Sprint.
They partner with Sprint.
Provide that infrastructure.
Yeah.
Virgin focuses on the branding, targeting a specific demographic.
That's right.
Again, minimizing risk by using what's already there.
That's it.
Huge potential upside. No massive initial investment.
Yep.
Genius.
Pretty much.
Okay, so we've got motels, Richard Branson. Any other surprising Dhandho stories out there?
Lakshmi Mittal, the steel magnate.
Oh, yeah.
Another fascinating case.
Okay.
He built this multi-billion-dollar empire not by building new steel mills,
Okay.
but by acquiring distressed assets,
Wait.
often at bargain basement prices.
Distressed assets, isn't that inherently risky?
It's all about the price you pay.
Okay.
Mittal, he was a master of finding deals where the upside FAR outweighed the risk.
Okay.
He acquired these assets for pennies on the dollar,
Wow.
often from governments who were desperate to just offload them.
I see. So he's taking advantage of like a market inefficiency.
Yeah.
When fear drives prices down.
Exactly.
He sees opportunity where others just see risk.
That's the recurring theme here.
Right. You know what? This actually reminds me of a story you told me about your own Dhandho experience before you got into podcasting.
Yeah.
You remember that?
Fill me in.
My little $30,000 investment
Oh, right.
turned into a 150x return in 10 years.
Yeah.
Yeah. Looking back, it was a classic Dhandho play.
Walk us through it.
All right. So back in the day, I realized there was this huge demand for skilled tech workers in the U.S.
Okay.
But the supply was limited.
Right.
And at the same time, I knew that India had all these talented engineers.
Okay.
So I started this business connecting those two needs, kind of like a precursor to today's outsourcing firms.
So you were, arbitraging talent?
Yeah, pretty much.
You saw that price difference between the high cost of U.S. tech talent
Right.
and the lower cost in India.
Exactly.
And that became your moat,
That's it.
your competitive advantage.
And to minimize the risk, I kept my costs super low.
Okay.
I bootstrapped the whole thing, didn't take on any debt.
Smart.
I even had clients lined up before I quit my job.
Wow.
It was all about limiting that downside.
And it paid off big time.
It did.
You saw the potential, minimized the risk,
Yep.
and you ended up with this massive return.
It's Dhandho in action.
Dhandho in action.
And it's not just about the money.
No.
That is a nice perk.
Yeah.
It's about the freedom, the flexibility, the control.
You're in control of your own destiny.
That's it.
Yeah.
So it seems like Dhandho can be applied to a pretty surprising range of businesses.
It's true.
Motels, tech startups, steel mills.
Yeah, you name it.
But what are the core principles? Is there a set of rules here?
There is a framework outlined in the Dhandho Investor.
Okay.
But it's important to remember these are guidelines, not rigid rules.
Right.
Okay. The foundation. Dhandho is about investing in existing businesses.
Hold on. We were just talking about all these entrepreneurs.
Yeah.
They all started businesses.
Right, but they didn't invent something totally new.
Okay.
They focused on existing business models.
Yeah.
They found ways to improve them
Okay.
or apply them to new markets. Right.
I see.
They were masters of execution, not invention.
So taking something that already works.
Yeah.
Finding a way to make it even better.
Exactly.
Or exploit a gap.
That's it.
Makes sense. Risk minimization perspective.
Right.
Okay, second principle.
Focus on simple businesses,
Okay.
ones that are easy to understand, predictable cash flows.
Okay.
You want to be able to look at a business and say, I get how this makes money.
So no fancy tech startups
No.
with their algorithms and unproven revenue model.
Keep it simple, keep it clear.
Keep it simple.
Yeah.
Okay, I like it.
Now, this might sound boring to some people,
I can see that.
but remember,
Yeah.
boring can be very profitable.
Right. Exactly.
And even simple businesses,
Yeah.
they can have hidden complexities or be undervalued by the market.
Oh, interesting. So you're looking for those hidden gems that
Yes.
everybody else is overlooking.
That's it.
Then you apply those principles to maximize it.
Exactly.
I'm starting to see the appeal.
Yeah.
All right, next principle.
This one might sound counterintuitive at first.
Okay.
Invest in distressed businesses.
Hold on.
Yeah.
Distress.
In distressed
That
industries.
sounds like the opposite of low risk.
It can be risky if you overpay,
Okay.
but it can also be a source of tremendous opportunity.
Okay.
Think about this. If you can find a business that's fundamentally sound,
Mhm.
but it's been beaten down by the market,
Okay.
or it's facing, some temporary challenges.
Like those distressed motels Papa Patel was buying.
Exactly.
They were good businesses, just needed a little love.
Right. They might be facing a short-term crisis,
Mm-hmm.
but if they have a durable competitive advantage, they can bounce back.
I see.
Think of it like buying $1 for 50 cents.
I love those deals.
Right.
Okay, I'm starting to see the appeal.
Good.
But how do you know if a distressed business is actually worth investing in?
That's where the fourth Dhandho principle comes in.
Okay.
Invest in businesses with durable moats.
Moats, like a castle moat.
Think of a moat like a castle's defenses.
Okay.
Right. It's a barrier that protects a business from competition.
So it's like a strong brand or a loyal customer base or unique product, something like that.
You got it.
Okay.
This is especially important when you're investing in distressed businesses.
I see.
You need to be confident they have what it takes to weather the storm
Okay.
and come out on top.
That makes sense.
Right.
Okay, so we've got 4 principles so far. Invest in existing businesses.
Yeah.
Focus on simple businesses.
Simple.
Look for distressed opportunities
Yeah.
and seek out those durable moats.
Durable moat.
It's like a masterclass in like unconventional investing.
Yeah, it is.
All right, what else?
Now we're getting to the heart of Dhandho.
Ooh.
The 5th principle is this
Oh,
bets,
Okay.
big bets,
Okay.
infrequent bets.
Ooh, so you're not spreading your money around like a typical diversified portfolio.
Exactly.
You're concentrating on a select few.
A select few.
Okay, but isn't that risky? Putting all your eggs in one basket, so to speak.
It can be.
Right.
That's where thorough due diligence comes in.
Okay.
We're not just throwing money at anything.
Right.
We're carefully evaluating each opportunity to ensure the odds are in our favor.
I see.
You got to find those rare situations where the potential reward far outweighs the potential risk.
Right.
Does that make sense?
Yeah, so it's like finding a needle in a haystack, but when you find it,
You go all in.
you go all in.
Yeah.
All right, I like it.
Good.
But infrequent bets, how often should you be buying and selling?
This is the opposite of day trading.
Okay,
It's about patience.
got you.
You're not trying to time the market.
Right.
You're looking for long-term investments.
Okay.
So you should only be buying or selling when you have a very high level of conviction.
So no chasing hot stocks, no riding the latest trends.
Nope.
It's about finding those hidden gems and holding on to them
Holding on.
for the long haul.
That's it.
That's a very different approach
It is.
than what you usually hear in the financial world.
It's a different beast.
All right, so 5 Dhandho principles.
5.
Invest in existing businesses.
Yeah.
Focus on simple businesses.
Yep.
Look for distressed opportunities.
Mm-hmm.
Seek out those durable moats.
Right.
And then
Yeah,
make a few big, infrequent bets.
Infrequent bets.
My brain is already buzzing with ideas.
Good.
What's next?
The 6th principle is where things get even more interesting.
All right, bring it on.
Fixate on arbitrage.
Arbitrage. That sounds a little intimidating.
It can sound complex,
Yeah.
but at its core, it's about exploiting price differences.
Okay.
It's about buying something low in one market
Right.
and selling it high in another.
So finding those inefficiencies.
Exactly.
Taking advantage.
That's it.
Okay.
Now, are you ready for some concrete examples of arbitrage in action?
I'm ready. Let's get our hands dirty.
Okay, we've got traditional commodity arbitrage,
Okay.
where you might buy oil low in one country,
Right.
sell it high in another.
Okay.
We got correlated stock arbitrage,
Oh, okay.
where you exploit price differences between two stocks that tend to move together.
All right.
And then there's merger arbitrage.
Merger arbitrage. That sounds very Wall Street.
Yeah, this is where you take advantage of price discrepancies that come
Okay.
up when one company announces they're going to acquire another.
I see.
So many ways to profit from these price differences.
And Dhandho arbitrage. How's that different? I'm really curious about that one.
It's a bit unique.
Okay.
It's less about exploiting existing price differences
Okay.
and more about creating value with minimal risk.
Right.
Remember our example of the barber?
Yeah. Yes.
Right. He sets up shop in a new town.
No other barbers.
No other
He
barber.
fills the need.
Exactly. He creates a temporary monopoly, right?
Yeah.
And he does it in a way that minimizes his risk.
He does.
Doesn't need a lot of capital.
Right.
High probability of success.
I see.
That's Dhandho arbitrage.
So it's about finding those win-win situations.
Yep.
Where you're providing a valuable service and profiting from it at the same time.
Exactly.
And these opportunities, they're everywhere, right?
Absolutely they are.
Not limited to any specific industry.
Be creative, be observant,
Right.
find those unmet needs that others have overlooked.
That's a good point.
Yeah.
So we've got 6 Dhandho principles.
6.
Down. I feel like I'm seeing the world in a whole new light.
Good.
All right. What's the next principle on our list?
Principle number 7.
Okay.
It's all about protecting yourself from the unknown.
All right.
It's called the margin of safety.
Margin of safety, we touched on this earlier,
We did.
but remind our listener what that means.
It's the difference between the price you pay for an asset
Okay.
and its intrinsic value.
Okay.
Think about it like you're buying something for less than it's worth.
Oh, like a discount.
Like getting a discount, yeah.
Okay.
The bigger the discount, the lower your risk.
So it's a buffer,
It's a buffer.
a cushion
A cushion.
against the unexpected.
Right. So even if your valuation is a bit off,
Yeah,
you've got that margin of safety to kind of protect you.
I see.
And margin of safety is crucial in Dhandho investing
Okay.
because we're often dealing with situations where there's a lot of uncertainty about the future.
So you're not just betting on what you know,
No.
you're also protecting yourself from what you don't know. That makes a lot of sense.
Yeah.
Do you have an example of that?
Warren Buffett's investment in the Washington Post
Oh, yeah.
back in 1973.
Okay.
Classic example.
Okay.
He saw this business,
Yeah.
durable moat,
Right.
strong brand, loyal readership,
It's all there.
all those things we look for.
Yeah.
But the market was undervaluing it
Okay.
due to some, short-term concerns.
I see.
So he was able to buy it at a significant discount,
Okay.
gave him that huge margin of safety.
Right.
And because he was patient and he understood the long-term value,
Yeah.
he was able to hold on to those shares for decades, reap the rewards.
Classic Dhandho.
Classic example.
Okay, 7 Dhandho principles.
That's it.
Invest in existing businesses. Focus on simple businesses. Look for distressed opportunities. Seek out durable moats. Make a few big, infrequent bets.
Yep.
Fixate on arbitrage. Always seek a margin of safety.
Always.
This is an incredible toolbox for any investor.
It really is.
All right, what's next?
Principle number 8
8.
might be the most paradoxical one of all.
Okay.
Invest in low-risk, high-uncertainty businesses.
Wait, low risk A&D, high uncertainty.
I know.
How can those two things even go together?
It sounds counterintuitive.
Yeah.
But think about this. Uncertainty, it often creates fear in the market, right?
Okay.
Which leads to lower prices.
I see.
This gives you the opportunity to find undervalued businesses,
Okay.
even in situations where the future's uncertain.
So you're profiting from other people's fear.
You could say that.
But how can you be sure that these businesses are actually low risk?
That's where your due diligence comes in.
Okay.
You need to thoroughly understand the business,
Right.
the industry, the potential range of outcomes.
Gotcha.
You need to be comfortable with the unknown,
Okay.
but only after you've assessed that downside risk.
I see. So it's not about being reckless.
No.
It's about being calculated.
Calculated, yeah.
Like it.
The best Dhandho opportunities often lie in those areas where other people are too scared to tread.
Right. They see uncertainty and they run.
They run
You see opportunity.
opportunity.
Can you give an example of that? A low risk, high uncertainty business.
Stewart Enterprises.
Stewart Enterprises, who are they?
They were a funeral services company.
Funeral services? That's a pretty morbid business.
It is.
Yeah.
But it's also a very stable business.
How so?
People are always going to need funerals, right?
That's true, I guess.
Yeah.
And Stewart Enterprises, they had a dominant position.
You did.
Where's the uncertainty?
They'd taken on a lot of debt.
Okay.
There were concerns about their ability to repay it.
Right.
The market perceived them as risky.
Okay.
Their stock price plummeted.
And you saw an opportunity?
The business itself was solid.
Okay.
The market was overreacting to the debt,
Okay.
and the price was significantly below the intrinsic value.
Gotcha.
Yes.
So you bet on their ability to turn things around.
It was a classic low-risk, high-uncertainty situation.
And it paid off.
It did.
Okay, that makes sense.
Yeah.
Any other examples of these, like, paradoxical investments?
Level 3 communications.
Okay.
They were a telecommunications company
Okay.
in a high HY competitive industry.
So another distressed business in a risky industry.
Right. But they had a strong management team,
Okay.
a solid business model.
Mm-hmm.
They were trading at a significant discount to their intrinsic value.
I see.
Again, low risk, high uncertainty, opportunity that paid off handsomely.
Okay, this is incredible. 8 Dhandho principles down.
8 down.
I feel like I've learned more about investing in this conversation than I did in my entire finance class.
Good, good.
What's next?
Principle number 9.
All right, number 9.
This one might sound a little controversial.
Okay, I'm ready.
It's better to be a copycat
Copycat?
than an innovator.
Wait, are you telling me to avoid innovation?
Not entirely.
Okay.
But remember,
Yeah.
Dhandho is about minimizing risk.
Right.
And innovation, by its very nature, is risky.
Okay.
Most new businesses fail.
That is true.
Right.
Okay.
So it's safer to invest in businesses that have a proven track record.
Okay, so you're looking for businesses that have already demonstrated success.
That's it.
They're not trying to reinvent the wheel.
Yeah.
They're taking something that works,
Yeah.
making it even better.
That's right.
So it's about execution, not invention.
Execution.
That's interesting.
It is.
Do you have some examples of successful copycat businesses?
Oh, yeah.
Like, who comes to mind?
McDonald's is the classic.
McDonald's, okay.
Right. They didn't invent the hamburger,
Right.
but they perfected the system for making and selling them.
Interesting.
Took an existing idea, scaled it up, turned it into a global empire.
That's true, and they keep innovating, right?
They do.
Within their proven model.
That's the key.
New products, new ways to reach customers.
Not blindly copying.
Right. Expert speaker.
You know, as we were talking about this Dhandho stuff, it reminds me of another approach that has some interesting parallels.
Okay.
Joel Greenblatt's magic formula.
Oh, yeah. The magic formula.
Have you ever looked into that?
It rings a bell, but refresh my memory.
Huh?
What is that all about?
It's this stock picking strategy
Okay.
that focuses on finding undervalued companies with high returns on capital.
Okay.
And the really fascinating part,
Yeah.
a lot of these magic formula picks, they actually align with the Dhandho principles,
Interesting.
even though they weren't designed that way.
So you're saying that if I use the magic formula,
Yeah.
I might accidentally end up with a portfolio full of Dhandho-like businesses?
It's possible.
Okay.
Both approaches
Yeah.
emphasize fundamentals,
Okay.
profitability, using capital efficiently. It's almost like a shortcut
Oh, interesting.
to identifying those potential Dhandho opportunities.
But you said almost.
Yeah.
So it's not a perfect overlap?
No formula is perfect.
Right. Right.
You always have to do your own due diligence,
Of course.
really understand the business right.
Right.
The magic formula can be a useful starting point.
I see.
It's a good way to narrow down the field,
Okay.
but it's not a substitute for careful analysis.
No shortcuts to success.
That's right.
Okay, well, while we're on the topic of tools,
Yeah.
you mentioned margin of safety earlier. Remind our listener what that is.
Okay, it's all about buying an asset for less far than its true worth.
Okay.
It's that difference between the price you pay and what the business is actually worth.
Okay.
What we call its intrinsic value.
Okay, so like getting a discount.
Think of it like a discount, yeah.
Okay.
But instead of on a sweater, you're getting a whole company.
I love those kind of discounts.
Right.
Okay, but how does that actually lower my risk?
It gives you a buffer,
Okay.
right?
Yeah.
Even if your valuation's a bit off,
Right.
you've got that cushion to protect you from losses.
I see.
And in Dhandho, where we're often dealing with these high uncertainty situations,
Right.
that margin of safety can be crucial.
It's like an insurance policy
Yeah, think of it that way.
against the unknown.
Against the unknown, exactly.
Can you give an example of how margin of safety works in the real world?
Warren Buffett's investment in the Washington Post
Ah, classic.
back in '73.
Okay.
Classic example.
Okay, break it down for us.
He saw this business.
Right. Yeah.
Strong brand, loyal readership.
Yeah.
All those things we look for in a Dhandho investment.
It's all there.
But the market was undervaluing it
Okay.
due to some short-term concerns.
Oh, I see.
So he was able to buy it at a price
Yeah.
far below its intrinsic value,
Yeah.
gave him a huge margin of safety.
Right.
And because he understood the long-term potential of the business, he wasn't fazed by those short-term hiccups.
Right. He was patient.
Held on to those shares for decades.
And it paid off. Right.
It did.
Classic example of how that margin of safety combined with the long-term Dhandho mindset. Incredible returns.
Exactly.
All right, we've covered a lot of ground.
We have.
Dhandho principles, magic formula, margin of safety. Yeah. It's a lot to process.
It is.
You know, all this talk about successful investments, it's making me think about my own Dhandho journey.
Oh, yeah. That business you started all those years ago.
Yeah, that one. The one that yielded like 150x return.
The one that started with just $30,000.
That's the one.
I think our listener would be fascinated to hear more about that.
It really was a textbook Dhandho play, even though, I didn't know it at the time.
Right.
It all started with this simple observation.
Okay.
There was this huge demand for skilled tech workers in the U.S.
Okay. Yeah.
But the supply was limited and
Yeah.
expensive.
Expensive, yeah.
At the same time, I knew that India had this vast pool of talented engineers
Right.
and that their labor costs were significantly lower.
So classic supply-demand imbalance,
Yeah.
ripe for disruption.
What did you see that others missed? I knew that India had all those engineers. Their costs were much lower.
Yeah.
So I started this business connecting those two needs.
I see. Like a precursor to today's outsourcing firms?
Yeah, pretty much.
So you were essentially like arbitraging talent.
Yeah, you could say that.
You saw that price difference between those two markets.
That's it.
And that became your moat, your
Exactly.
competitive advantage.
And to keep the risk low, I bootstrapped the whole thing.
Okay.
No investors, no debt, my own savings, and a lot of hustle.
A lot of hustle.
I focused on landing clients before I even quit my job.
So you had revenue coming in from day one.
Day one.
Classic Dhandho move.
Right. Minimize that upfront investment.
Exactly.
Secure that revenue stream.
Yeah. All those things we've been talking about.
All those things.
Sounds like you had a natural instinct for this approach.
Maybe so, maybe so.
Yeah.
It wasn't all smooth sailing, of course.
Of course not.
But the potential upside was so much greater than the downside.
Right.
It was a bet I had to take.
It was a bet you had to take.
And in the end, it exceeded all my expectations.
It's amazing how those Dhandho principles
Yeah.
can lead to success.
They do, even when applied to these unconventional businesses.
Absolutely. And it's not just about the financial rewards.
No, it's not just the money.
Though that is a nice perk.
It is.
It's about the freedom,
the freedom.
the control
Yeah.
that comes from building something on your own.
You're in the driver's seat.
That's it. Those intangible rewards, just as valuable.
Absolutely.
That's what Dhandho is all about, right?
It is.
Taking control.
Taking control.
Your finances, your future,
Yep.
your destiny.
That's it.
Okay, so speaking of Dhandho principles,
Okay.
we've talked a lot about the importance of simple businesses.
We have.
How do we actually identify those?
That's a great question.
What should we be looking for?
One of the best ways
Okay.
is to look at a company's financial statements.
Okay, financial statement.
No,
It can sound a little intimidating,
It can, yeah.
but it's really not that complicated.
Not as bad as you think.
Okay, so where do we start? What are we looking for? First and foremost, you want to see a high return on invested capital.
Okay. Return on invested capital.
This tells us that the business is generating good profit
Okay.
relative to the amount of money that's been invested in it.
So it's not just about making a profit.
No,
It's about making a profit efficiently.
efficiently, yeah.
Okay, what else?
A strong balance sheet.
Strong balance sheet.
This means the company has more assets than liabilities,
Okay.
which puts them in a good position to weather any financial storms.
Makes sense, like a solid foundation.
Solid foundation.
What else?
Consistent cash flow.
Okay, cash flow.
This means the business is generating money on a regular basis.
So it's not just
None fits and starts.
up and down, up and down.
You want consistency.
Okay, so
yeah.
so high return on invested capital, strong balance sheet,
Yep.
consistent cash flow.
3 key things.
That's what we're looking for in a simple business.
That's it.
I'm taking notes.
Good.
All right, so then durable moats.
Durable moat.
How do we spot those?
You're looking for signs of a sustainable competitive advantage.
Okay.
Something that sets a business apart from its competitors.
Makes it harder to compete.
Harder to copy, harder to compete, yeah.
So like a strong brand or
Strong brand,
loyal customers or
loyal customer.
unique product, maybe even exclusive access to some kind of resource.
Could be technology, yeah.
Okay, but how do we know if a moat is truly durable?
That's the question.
Couldn't a competitor come along and just disrupt the whole thing?
It's always a possibility.
Right.
But some moats are stronger than others.
Okay.
You got to look at the industry, the competitive landscape,
Right.
the barriers to entry.
Okay.
How easy is it for new players to come into the market and compete?
Right.
If those barriers are HEH, that's a good sign.
Because it means they're likely to maintain that advantage.
Exactly.
Okay, that makes it a much more attractive Dhandho investment.
It does.
So a durable moat is like what, like a castle wall?
Like a castle wall.
Protecting them from invaders.
That's a good analogy.
Okay, let's shift gears a little bit.
Go.
Talk about the Kelly formula.
The Kelly formula.
Remember that?
Yeah.
That helps you figure out how much to bet on an investment.
That's right.
How can our listener, who maybe doesn't have a math background, actually use it?
It can be complex, but the key takeaway is this.
Okay.
You should only bet a portion of your capital
on
any given investment.
Right.
The Kelly formula, it helps you figure out what that optimal bet size should be based on the probability of winning and the potential payoff.
So it's a way to be bold, but also prudent.
Prudent, yeah.
Big bets.
They get bet.
But not betting the farm on any single opportunity.
That's the idea.
So it's a balancing act.
It's a balancing act.
The Kelly formula helps you find that sweet spot.
That sweet spot.
Between risk and reward.
Risk and reward, that's it.
So it's not about diversification. It's about those concentrated bets.
Concentrated bets.
On your highest conviction ideas.
That's right.
Which, again, very different approach
Very different.
than what most people are taught about investing.
It is.
Okay, I like it, though.
Yeah.
All right, let's dive back into arbitrage.
All right, back to arbitrage.
We talked about it conceptually.
We did.
But let's get into some specifics.
Specifics. Let's do it.
I'm ready to get my hands dirty.
All right, good.
Give me some examples.
Okay, let's start with traditional commodity arbitrage.
All right, traditional commodity arbitrage.
This is about exploiting those price differences for things like oil, gold, wheat, other commodities.
Okay.
You might buy oil low in one country, sell it high in another.
So you're acting as like a middleman.
Yeah, kind of like a middleman.
Connecting those buyers and sellers in different markets.
That's it.
Profiting from the difference.
Right, and because you're locking in that profit by simultaneously buying and selling. It's a relatively low-risk way to generate returns.
That's pretty good.
But it takes skill, it takes speed, and a good understanding of those markets to execute those trades successfully.
So it's not for the casual investor.
It's not for everybody, no.
You got to know what you're doing.
Yeah, you really do.
Okay, what other types of arbitrage?
We've got correlated stock arbitrage.
Okay, correlated stock arbitrage. Walk me through that one.
All right, you're exploiting price differences between two stocks that tend to move together.
Okay.
Sometimes one stock might be temporarily mispriced relative to the other.
I see.
Creating an opportunity.
So you buy the undervalued one, sell the overvalued one.
That's it.
Betting that the prices will eventually kind of meet in the middle.
Converge, yeah.
All right.
It's a low-risk strategy because you're essentially betting on the relationship between those two stocks.
Right.
Rather than the direction of the market as a whole.
Interesting.
So even if the market goes down, you can still profit as long as that price difference between the two stocks narrows.
I see. Okay.
But again, it takes expertise and timing to really identify these opportunities and execute the trades effectively.
Right.
Now, ready for another type of arbitrage?
I'm ready. Lay it on me.
Merger arbitrage.
Merger arbitrage. That does sound very Wall Street.
Yeah.
How does that work?
It's about exploiting price differences.
Okay.
When one company announces it's going to acquire another company, typically the stock price of the target company jumps up.
Right. Makes sense.
But it often doesn't jump up to the full acquisition price.
Oh, interesting.
There's a gap there.
Okay.
Between the current price and the final buyout price.
I see.
That gap is the arbitrage opportunity.
You buy the stock of the target company.
Get the lower price.
At the lower price.
Wait for the merger to close.
And if it goes through?
If it goes through,
boom, profit.
You pocket the difference.
That sounds almost too good to be true.
I know, right?
What's the catch?
The main risk is that the merger falls apart.
Ah, right. Deals can fall through.
Deals can fall through, yeah.
Okay.
For various reasons.
Right.
And if that happens, the stock price of the target company, it could plummet.
So it's not as low risk as commodity or correlated stock?
No. Oh. You're essentially betting.
Betting on the deal.
That the deal goes through.
Okay. I see.
But If you do your due diligence, understand the terms of the merger, assess the likelihood of it being completed, it could be a very profitable strategy.
It can be. Okay.
Now, let's circle back to Dhandho arbitrage.
Ah.
Yes. Remember that.
The one that's not about exploiting existing price differences. It's about creating value.
Creating value, that's it.
Tell me more.
Dhandho arbitrage is about identifying opportunities to create this win-win situation.
Okay.
Where you're providing a valuable service or a valuable product.
Okay.
And you're profiting from it. Remember our example of the barber setting up shop?
The barber? Yeah.
In the new town?
No other barbers.
No other barbers.
He sees the need.
He sees the need.
Fills it. Creates value for himself and the community.
Exactly. And he does it in a way that minimizes his risk.
Right.
Doesn't need a lot of capital to get started.
Right.
Very high probability of success.
He's going to do well.
Right.
Yeah.
That's Dhandho arbitrage.
So it's about being creative.
Yeah.
Being observant.
Oh, it's very...
Finding those unmet needs that other people have just overlooked.
That's it.
And these opportunities, they can be anywhere, right?
Absolutely.
Not just in the stock market.
Not just in the stock market.
Okay, but before we get too philosophical here, let's stick with the practical. We've talked about buying, selling, arbitrage. There's one more crucial aspect of Dhandho that I think we need to address.
Okay, what's that?
The psychological side.
Ah, the psychological side. Very important.
Because Dhandho is as much about mindset as it is about strategy.
Couldn't have said it better myself.
Okay, so one of the most important psychological aspects
Yeah.
is being comfortable with uncertainty.
That's a tough one.
It is, because uncertainty can be scary.
It is.
You know, we as humans, we want to avoid it.
Right. We crave certainty.
Seek certainty, predictability.
We want to know what's going to happen next.
Exactly. How do we embrace the unknown?
It takes practice.
Okay.
Self-awareness.
Yeah.
And a willingness to, like, challenge your own assumptions.
I see.
Dhandho is about understanding that you don't know everything.
Okay.
That you can't predict the future with 100% certainty.
And that's okay.
And that's okay.
That sounds almost counterintuitive.
It does.
You'd think that successful investors, they have some kind of crystal ball.
Yeah, like they can see the future.
They make perfect decisions.
Right.
But you're saying it's the opposite.
It's about humility.
Humility.
Realizing you can't control everything.
Right.
There will always be unknown factors.
Right.
Unexpected events.
You can't plan for everything.
You can't.
Okay.
So the key is to focus on what you can control.
Which is?
Your own actions.
Okay.
Your own decisions.
Right.
Your own risk management.
So you're not trying to outsmart the market.
No.
You're trying to manage your own behavior.
Your own behavior, yeah.
Make smart bets.
That's
based on sound principles.
Sound principles, exactly.
So you're embracing uncertainty.
Yeah.
But you're also being very disciplined about managing your risk.
You have to.
It's like a Zen paradox.
It is. It is.
Isn't it?
And the best Dhandho investors, they seem to have this almost intuitive grasp of this balance.
Yeah.
They're not afraid to make those bold moves.
Okay.
But they're always thinking about the downside.
Right. Protecting their capital.
Protecting their capital. That's key.
So they see what others miss. They have the guts to act when others hesitate.
Yeah.
And they have the patience to hold on.
Hold on.
When others panic.
When others panic, exactly.
That's the don't-know mindset.
That's it.
Not something you can learn overnight.
No.
It's something you develop over time.
Takes time.
Experience, study, self-reflection.
All those things.
So for our listener who's just starting out on this journey, what's one piece of advice?
Start by focusing on the principles that resonate with you the most.
Okay.
Don't try to do everything at once.
Right.
Maybe you start with finding simple businesses.
Okay.
Maybe you focus on looking for those distressed opportunities.
Right.
Whatever sparks your interest.
Mm-hmm.
Dive deeper into that principle.
Okay.
And see how you can apply it.
Yeah.
To your own investments.
It's about finding your own Dhandho style.
Your own style.
The approach that feels right for you.
That's it.
The more you learn,
the
more you experiment, the more you develop that intuition.
That Dhandho intuition.
Right. That ability to spot those hidden gems.
That's it.
Like any skill.
Yeah, like any skill.
The more you practice.
Practice makes perfect.
The better you get.
Better you get. The
rewards.
Life-changing.
Life-changing, yeah.
We've talked about the strategies, the numbers, all the, the analytical side of Dhandho.
Right.
But it really seems like there's this equally important mental game involved.
Oh, absolutely.
Can we dig into that a bit more?
Yeah, let's do it.
What is that Dhandho mindset?
It's about embracing the limits of your own knowledge,
Okay.
Acknowledging that you don't know everything.
Right.
You can't predict the future with 100% certainty.
And that's okay.
And that's okay.
It's kind of counterintuitive, isn't it?
It is.
You think these super successful investors,
yeah,
they have a crystal ball or something.
Right.
They see the future, make perfect decisions.
Yeah.
You're saying it's the opposite.
Dhandho is about humility.
Realizing you can't control everything.
Okay.
There will always be unknown factors, unexpected events.
You can plan for everything.
You just can't.
Right.
So the key is to focus on what you can control.
Which is?
Your own actions.
Okay.
Your own decisions, your own risk management.
So you're not playing chess against the market. You're managing your own behavior.
Exactly.
Making smart bets based on those sound principles.
That's it.
So you're embracing uncertainty.
Yeah.
But at the same time, being super disciplined about managing the risk.
You got to find that balance.
Almost like a Zen paradox.
It is a bit of a paradox, yeah.
The best Dhandho investors, they seem to have that intuition,
They do.
Like a sixth sense.
They've got a feel for it.
For these low-risk, high-uncertainty plays, they see what others miss. They have the guts to act when others hesitate. And they have the patience to hold on when others are panicking.
They're in it for the long game.
That's the Dhandho mindset.
That's it.
Can't learn that overnight.
Takes time.
So for our listener, just starting out,
Yeah.
What's one piece of advice you'd give him?
I would say start by focusing on the principles that really resonate with you.
Okay.
Don't try and do everything at once.
Right.
Maybe you start with those simple businesses. Or you look for the distressed opportunities. Whatever gets you excited.
Okay.
Dive deeper into that. See how you can apply it.
Your own Dhandho style, right?
Your own style, exactly.
The more you learn, the more you experiment.
You got to experiment.
The more you develop that. The more you practice.
Practice makes perfect.
The better you get. That's it.
And the rewards.
Oh, the rewards can be life-changing.
They can be, yeah.
This has been an incredible deep dive.
It has.
We've gone from the origins of Dhandho in the Gujarati community to the stock market, even to our own lives.
Yeah, it's been a journey.
Talking about motels, steel mills, airlines.
Even ancient Indian warriors.
It's been a wild ride.
It really has.
So what's the one thing you want our listener to take away? The essence of Dhandho.
Dhandho is more than just these principles, right?
Okay.
It's a whole philosophy.
A philosophy, I like that.
It's about thinking about the world differently. Risk, reward, opportunity, uncertainty.
Okay.
It's about taking control, building wealth in a way that aligns with your values.
Finding those hidden gems, those overlooked opportunities, having the courage to act on them.
That's it.
Thinking long-term, minimizing risk, maximizing reward.
Absolutely.
And enjoying the journey.
That's the most important part.
That's a great point.
Yeah.
So until next time, happy Dhandhoing.